Okay, let's unpack this. We are diving deep into the financial pulse of Supreme Industries Limited, looking at their Q2 and half-year results for FY26. That's the period ending September 30th, 2025.
Right. And Supreme is, such a key player. What they do often tells us a lot about what's happening on the ground in construction, in infra,
Exactly, a real bellwether.
and this half year. It's fascinating, almost contradictory, really.
How so?
Well, our mission here is to understand this core tension. Supreme had really robust volume growth demand, seems strong. But at the same time, their profitability metrics, they looked deeply strained.
Okay, so strong sales volumes but weak profits.
Precisely. We need to decode that sort of financial schizophrenia and look at where they've been putting their money, serious capital deployment for the future.
Let's lay out that paradox right away for you. The company sold, 338,224 metric tons of plastic goods in H1.
That's the number, which is up 8.44% compared to last year. So decent volume growth.
And their net product turnover grew too, though maybe not as much. It's just modestly, about 2%. So you see that volume strength.
And you'd expect the bottom line to follow.
You would.
Yeah.
But that's where the story flips. Consolidated operating profit, EBITDA, that actually fell.
Fell. By how much?
Significantly. Almost 15% year-on-year for the half. And profit after tax, PT, dropped even more sharply. Nearly a quarter gone down 24%.
Wow. Okay, so that really sets up the theme.
Mm-hmm.
Maybe some short-term pain here for long-term gain.
I think that's exactly it. Short-term pain for long-term power.
So if they're selling more stuff, fundamentally, why are the profits cratering? What's the main reason for that margin squeeze?
Yeah, it's not really about internal ops failures. You have to look bigger picture at the commodity markets.
Okay.
Management was pretty clear. The global economy is in a bit of a low-growth phase. And critically, you've got all these new petrochemical plants coming online.
Supply side pressure.
Exactly, flooding the market. And that combination just sent crude oil and polymer prices, PVC, CPVC, polyolefins, basically on a steady downward slide through the first half. Right. And when raw material prices drop that fast, anyone holding inventory bought earlier gets hit.
That's the inventory loss mechanism. Imagine buying plastic pellets in, say, April at 100 rupees a kilo.
Okay.
By September, maybe the market price is only 80 rupees. Even if you're selling a finished pipe, you have to price it based on that current 80 rupee cost to stay competitive.
So the difference, that 20 rupees on the inventory you bought at 100, you have to book as a loss.
You got it. And for Supreme, this wasn't trivial.
No, the sources mention an inventory loss around 50 to 60 crore rupees in H1.
Yeah, 500 to 600 million rupees. It's a big number.
It's huge.
And here's the key synthesis point. That specific loss, which is kind of non-operational, it almost entirely explains that 15% drop in EBITDA we saw.
Okay. So if you mentally backed out that inventory hit.
Their underlying operating margins would look much, much healthier. It suggests the core business is actually performing quite well, just dragged down temporarily by this commodity price thing.
That completely reframes the half-year results then. And it makes management's confidence about the full year. Maybe less like wishful thinking.
Right. They're sticking to a pretty ambitious full-year operating margin target. 14.5% to 15%.
Despite H1 margins being much lower, I think standalone was around 12.3%.
Correct. They're basically expecting the second half to be significantly better than the first.
What are they banking on for that turnaround?
Two main things, really. One, stable or maybe even recovering polymer prices. They think that downward trend that caused the losses will ease off.
Okay, less inventory pain.
Hopefully. And two, the classic post-monsoon demand surge. Construction, agriculture, it all picks up in H2. They believe that demand, combined with stable prices, will let their operational efficiency shine through.
That confidence needs to be backed by capacity, though. Which brings us neatly to the big strategic move in Q2, the Waven acquisition.
Yes, this was a major deal. Effective August 1st, 2025, Supreme Industries bought the plastic pipe business of Waven Industries Limited.
And this wasn't just buying a brand, it included actual factories.
Oh yeah, 3 operating manufacturing sites, Vanmore, Timapur, and Nimrata. So immediate physical capacity addition.
Right. How much capacity did that add, and what did it cost them?
It added about 71,000 metric tons per annum of installed capacity straight away. The price tag was an aggregate consideration of 302 crores, which also included net working capital.
302 tour. Okay. But the real kicker here, I think, wasn't just the factories. It was the technology access they got alongside it.
Absolutely critical point. You cannot overlook this. They signed a master technology license agreement with Waven BV, the parent company in the Netherlands.
And that gives them.
Exclusive access for 7 years across India and the SAARC countries to all of Waven's existing and future proprietary piping tech.
Wow. 7 years of exclusive access to potentially cutting-edge stuff.
Exactly. Think complex systems, high-pressure applications, things often needed for big infrastructure projects. It's like a technology shortcut for the next 7 years.
That really could shift them from just being a big volume player towards being a more sophisticated technology provider, especially in those high-value segments.
That seems to be the plan.
Any indication of how that acquired business is doing initially?
Yeah, the ramp-up seems okay. The first 2 months they had it, August and September, the Waven business sold about 3,000 tons.
Okay.
And management thinks that'll scale up to around 20,000 tons just in the remaining 8 months of this financial year.
And the big picture goal for capacity?
Huge. By the end of March 2026, so end of this fiscal year, they expect their total piping system capacity to cross the 1 million ton mark.
1 million tons just for pipes. That's massive scale.
Monumental.
Mm-hmm.
And the overall company capacity, including other segments, will be over 1.2 million tons.
Okay, let's pivot to how the segments actually perform. Plastic piping, obviously the main engine. How did it do in this tricky H1?
Well, the underlying demand was definitely there. Q2 volume growth was strong, 17%.
17%.
Yeah, which pushed the H1 volume growth for pipes to a healthy 11%. But management said it could have been even better. It was held back by a couple of things.
Let me guess. The monsoon.
You got it. Agricultural demand, which uses a lot of pipes, was hit because the monsoon arrived early this year and then just dragged on. Delayed farm work, installations, everything.
Okay, weather impact. What else?
Also, they mentioned lower government spending in infrastructure segments during H1 that dampened growth, too.
So it really highlights that vulnerability to agriculture, to weather patterns.
It does. And that's probably why the Waven deal, with its potential infrastructure focus, looks so strategic. They need to balance that out.
It makes sense. They need more consistent, less seasonal demand drivers.
Exactly. But despite those H1 headwinds, management is sticking to a really aggressive full-year volume growth target for pipes.
How aggressive?
15 to 17%.
Whoa, after just 11% in H1, they're really betting the farm on a massive H2 rebound then.
They absolutely are.
Yeah.
Big bet on post-monsoon recovery.
Is there anything specific giving them that confidence? Any particular product doing well?
Yes, actually. One interesting detail was CPVC pipes.
Ah, the higher value stuff.
Right. Use a lot in plumbing, residential. CPVC pipe volume grew by an impressive 26% in H1.
26%. Okay, that is strong.
Yeah, it suggests they're not just selling basic pipes. They're gaining share in these premium, higher realization products. That helps margins a bit too.
Okay, good sign. Now, looking beyond pipes, how did the other divisions fare? Any standouts or laggards?
There was one clear laggard, the industrial products segment. Management specifically called it out as, quote, the only division not faring well.
Ouch! What were its numbers like?
It saw an 8% volume degrowth in Q2, and value was down 14%, so definitely struggling.
Okay, any bright spots outside of piping?
Yes, the protective packaging products division seems to be doing quite well. They expect double-digit volume growth for the full year. And they're on track to hit a pretty big revenue milestone, 1,000 crore rupee turnover for the full year in packaging. They said that's driven by expanding the product range.
So this push towards more premium value-added products seems to be a theme across the board.
It definitely is. We saw the overall turnover from value-added products climb nicely. It was 1,073 crore in Q2 FY26, up from about 907 crore the year before.
And that premiumization strategy helps insulate them a bit from that raw material volatility we talked about earlier.
Exactly. When your product has more processing, more value add, the raw material cost becomes a smaller percentage of the total cost. So when input prices swing wildly, like they did in H1, the impact on your overall margin is buffered somewhat.
Right, makes sense. Okay, now let's circle back to the cost of all this expansion and ambition. Because getting here hit the balance sheet hard, didn't it? The cash position.
Oh, it's dramatic. Absolutely staggering change. The company started the financial year back on March 31st, 2025, with a huge net cash surplus, over 940 crore rupees.
Almost 1 billion rupees in cash.
Yeah.
Okay.
6 months later, by September 30th, That net cash surplus had plummeted to just 49 crore.
49, down from 944.
Yes, they basically burned through almost 900 crore rupees of cash in 6 months.
Wow. Where did it all go?
Straight into capital expenditure. The total H1 capex outflow was 869 crore. That includes the Wavin acquisition payment, plus all their other capacity expansions.
Okay. And they expect more outflow in H2.
Yeah, they're projecting the total cash outflow for the full year to be around 1,300 crore.
1,300 crore, that's a massive investment program. How are they funding all this?
This is important. They were very clear. It's all funded from internal accruals, generated cash from operations.
So no new major debt despite spending all that cash.
They insist they maintain no debt level in the long term. There are some current gross borrowings showing up around 240 crore.
Okay, so not zero debt right now.
Right, but they clarified these are just short-term, temporary borrowings. Probably for working capital needs during the big spend. They expect to clear that balance entirely by December 2025.
Got it. Aggressive growth, self-funded, using up the cash cushion, but aiming to stay debt-free long-term.
That seems to be the strategy.
Now, beyond just expanding existing lines and buying Wavin, Supreme is also pushing into completely new areas, right? High-tech diversification.
Yes, 3 interesting new launches or pushes to keep an eye on.
Okay, what are they?
First, targeting the high-end building market with silent pipes. Noise reduction in plumbing is becoming a bigger deal in premium construction.
Great.
So they've launched a PP silent pipe system. Brands are Serene and Serene Plus. And they're doing this in collaboration with an Austrian company, Poloplast Chamas.
Interesting. Okay, number 2.
Entering the window market, construction fit-outs. They've started initial production trials for a profile window project.
Windows, like UPVC windows.
Who's like it? Yes. Profile windows. Commercial launch is targeted for December 2025, so quite soon. Starting regionally, UP, NCR, Haryana.
Okay, pipes, packaging, industrial, and now windows. Diversifying. What's the third one?
Composite products. This division seems to be gaining traction, especially in energy infrastructure.
Oh, so.
They've secured major contracts for composite LPG cylinders with the big players BPCL, IOCL, and they also just executed their first order for CNG cascade cylinders, high-pressure gas storage.
Okay, so leveraging that composite tech into new energy applications.
Exactly. Seems like a promising area.
All right, so let's try to wrap this story up. They weathered a really tough H1 margin hit, mostly from external factors like falling polymer prices causing inventory losses.
Right. The underlying business volumes were actually pretty decent, especially in pipes.
But they didn't just sit tight. They made huge strategic moves, buying Wavin for capacity and, crucially, that exclusive tech license.
And they funded all this, plus other organic expansion, by deploying nearly their entire cash reserve. A massive bet on future growth.
So the narrative is really one of calculated risk. Accepting that short-term financial pain, the cash depletion, to lock in long-term scale and technology advantages.
I think so. And now they are heavily reliant on that post-monsoon demand kicking in strongly in H2 to start leveraging all that new capacity and hitting their big full-year targets.
Including that turnover goal of what, 11,000 to 11,500 crore rupees?
That's the number they put out there. It's a specific figure for you, the listener, to track.
Okay, so that leaves us with a key question, something for you to think about as we watch the next few quarters unfold. They've clearly got strong demand in areas like plumbing, but they've also spent heavily on Wavin's tech, which seems ideal for bigger infrastructure projects.
Right. And they acknowledged infra was slow in H1 and agriculture is weather dependent. So the provocative thought is this. Given these massive investments, especially the Wavin tech, what specific changes, operational sales focus does Supreme need to make to successfully pivot and really penetrate those large, less seasonal infrastructure markets?
How do they leverage that new capacity beyond their traditional strengths?
Exactly. Plumbing is good, but infra is the really big, potentially more resilient prize. What will it take to become a major infrastructure partner? And maybe the flip side, what are the main risks to them hitting that aggressive 15–17% pipe volume growth target if that H2 market rebound post-monsoon isn't quite as strong as they're hoping?
That execution, that strategic pivot in the face of market reality, that feels like the key thing to watch. Will the short-term pain truly deliver the long-term power they've bet so heavily on?
That's the question we'll be tracking.